The housing market is going to crash. The stock market's coming down afterwards. Just look at Redfin's prediction for 2025, where they talk about a 1% downturn in real estate prices. Oh my God, how are we going to get through it? Forgive me, it's almost comical the way that people think that we're going to have a housing collapse, that the stock market's going to crash. There would have to be some black swan event to actually cause this to happen. I just don't see it happening with the economy the way it is. People are employed, they're making money, and we have inflation. Inflation is not the dollar being devalued. I want to delineate the two and explain it a little. I have people in other videos and comments talking about how the dollar's devalued and that's why this is happening, and it's why your purchasing power is getting worse and worse, and. Go look at a chart of the dollar against almost any currency. Now, the one I watch is the yen, partially because I have some yen in an account and I watch it slowly get worth less and less money in comparison to the dollar. If the dollar was devaluing, that would be against other currencies. That isn't devaluing against the cost of a chair or eggs or even gold or other investments. That is called inflation, or a good investment, depending if you're talking about gold or things of that nature. That is not a devaluation of a currency. If the dollar was actually devaluing, that would have to be in relation to other currencies, and people seeing the dollar as less valuable is other fiat currencies. Totally different. So let's get our facts straight when we talk in the comments and the videos. And I don't mean to kind of pick on this, but I'm tired of hearing about this huge dollar devaluation that hasn't come. It's similar to the housing market that Nick from Reventure app has been talking about, a crash going on 5 years. I get it. He's built up millions of followers and he's doing incredibly well, but he's also been incredibly wrong. And one day, yeah, of course, there'll be a correction and I'm sure he could pat himself on the back. But in the meantime, talking tons of people out of saving and investing and maybe buying a home when prices have doubled over 4 years and interest rates have gone up. What good have you done with this prediction that you continue to push, along with many others, that hasn't come true? The funny thing is, I find him entertaining. I think the content is interesting, but you have to use your own perception and what you see going on. Unless we have huge unemployment, what's going to change things in the economy? Inflation could keep going and purchasing power could diminish, but it doesn't mean that people stop buying things and that the economy just stops. CPI has come down, showing that things are slowing a bit, but go out to any restaurant in your town. I'm sure you can go out of your way to find a mom and pop restaurant that's slowing and really struggling, but that's always the case. Similar to what I say about the foreclosure rate and anything along that nature. The reality is there isn't a whole lot of foreclosures. And why? Because prices have continued to drift higher. That's not called a foreclosure, that's called selling your house and moving on. And the golden handcuff thing, I can tell you that is a real thing. Not only myself, I know others who are kind of stuck in their home. Thank God we love our home and we're perfectly happy to be stuck here. But to be fair, I couldn't afford this house today, and we would have to consider something significantly less expensive. We afforded the home because it was less expensive and interest rates were super low at the time. But the cost to buy the house today, if somebody put 20% down, is close to 3 or 4 times what it cost 4 or 5 years ago. Very lucky. But other people are stuck in their homes for the same reason wherever they are, whether they're happy with it, whether they want to make a bigger purchase or whatever else. They may not be able to, and they're not going to look to sell their homes because the affordability of what they're in already is so good. They're just not going to move somewhere else and give that up. I also want to prepare people that when the Fed starts cutting rates, that is no guarantee that mortgage rates are coming down. Despite Trump waving in the air and he's going to get mortgage rates down, the reality is the president doesn't control that, and the Fed will only control that if they see a problem. And cutting interest rates is not what's going to determine that. If they want to do quantitative easing or quantitative tightening to try to control the mortgage rates, that's what would control it. But cutting short term overnight lending rates isn't what controls mortgages. The markets determine that, and we're more related to the 10-year treasury. And I'll explain it for a bit. If you've heard them in the news talk about an inverted yield curve, a normal yield curve, and it might be backwards because of the camera, would typically go like this. You know, on the short end over here, you would have rates low. It would then come out and slowly start going as you go out to 5 and 10 and 30-year treasuries. Why is that? Well, think about it just logically. If you were to lend somebody money, if you were lending money for a week, you may not need a whole lot of interest. If you were lending for 30 days, maybe you need a little bit more. But if you went out for a 5-year loan and you wanted to lend somebody money, don't you think you might want a little bit more of a return on that? And then if you went to 10 years, a little bit more, and 30 even more, which is why you tend to see a curve go up as you go further out on that chart. Now, when there was an inverted yield curve, what you actually had was higher interest rates here, and as you went out to 10-year and 30-year, they were actually lower. Why was that and what was going on? Especially during a time of inflation where, in my mind, longer term yield rates should have higher interest rates. Well, we were coming off of really low interest rates. And what the markets were predicting is we weren't going to see a lot of growth and the economy was going to slow. And despite that the Fed had raised the short term rates so quickly, in time, the longer term yields would actually be lower than where the overnight lending was. And the concept was that should slow the economy as well, bring CPI down. And what have we seen? Well, the economy pushed through it. And we've seen companies be able to increase earnings and things kind of normalize. It's been an amazing journey despite the negative rhetoric in the news. People haven't lost jobs. We didn't have massive unemployment and a huge recession, which the inverted yield curve kind of predicts. And that's the reason why is they're predicting a slowdown. As the Fed started to be able to cut the short-term rates, you actually saw the longer end of the curve start to go higher, which kind of implies the economy is doing okay and they're going to see continued increase in production and growth and even inflation, which isn't so terrible despite that we all hate it. If you go back to the 70s and 80s and 90s in the beginning, inflation was kind of normal. Things got more expensive over time. All of a sudden in the mid 90s, it kind of stopped. And as the internet boom really happened and people were able to find products everywhere and compete a little bit differently, you didn't see a lot of inflation for a long time. Prices stayed pretty stagnant up until COVID, which is really amazing. I mean, I remember conversations with my brother just scratching our head about how do companies even make money with as little as the margins are. Then COVID came around, the supply chains got all screwed up. Companies couldn't get product to the door. They were able to get rid of all of that inventory that they were stuck with because demand was still strong. And then things started to get out of control with the inflation because there weren't enough items. The Fed raised the rates to slow that down, but the long end of the curve took a long time to actually invert. Now that it's gotten there, unless we have a major recession, there's no reason for that to change. And even if CPI comes down and gives room for the Fed to start cutting rates, that's only the overnight lending rate. What that is overnight, the banks, Chase, JP Morgan, Wells Fargo, they can borrow and lend at what's called an overnight window. It's not really a window, but that's the term they use. It's just pressing buttons on a computer. If they've lent out a lot of money and they need to borrow, well, they borrow overnight from the Fed. That's continual. Every night, overnight, they borrow. They're able to lend at that rate if they have extra money, but that's pretty rare. They're generally just borrowing from the Fed. And then the rest of the market is determined by the open market and where people are buying and selling treasuries. As 10-year rates go higher and the cost of treasuries go lower, that's more what's associated to the mortgage rates. So when the Fed cuts the overnight lending rate, you'll see that come down, but that doesn't mean this end is necessarily going to come down as well. You might just see the yield curve continue to normalize. That's kind of my prediction. Now, if housing sales really slow and things really start to slow down, you'll see that end come down, which makes perfect sense. That's how it works. And then you'll see things kind of stay that way too, unless there's a huge recession. Now, if there's a huge recession and you see a bunch of unemployment, that's when the Fed would implement things like quantitative easing, and that's them actually getting involved in the bond market. They'll start picking things up. They may even go specifically to mortgage backed securities, which is what they did in the 2008 recession. It's also what they did during COVID to buy the interest rates down. What that means is they start buying the bonds, pushing the prices higher, driving the yields down. And it also gives a security to the banks that they know they have an out with the Fed to be able to sell their mortgage backed securities because their goal is just to get in and out and make a small amount of profit and not be stuck with potentially things that could go badly. Well, that's what you would need to see mortgage rates go dramatically lower, which is why I don't really predict it happening. I don't see what's going to cause this huge recession that everybody loves to chime in the comment section about how the world sucks and we're doomed and it's just so awful. Anyway, I got distracted with a phone call. I'm not quite sure where I was, but we're going to call it a day because it is Saturday and I'm going to go hang out with the family a bit, enjoy the beautiful day. We did some leaf blowing this morning, so hopefully you don't see any leaves on my yard. My son did the front, and I got to tell you, he's better than I am about making sure he gets every single leaf. It's really cute. Um, I thought it's super cool. It's just he's very detail oriented, and like I've talked about, great student in school. Now, I'll do my little rant. As always, none of this is financial advice. You need to do your own research when making any financial decisions. This is just for entertainment purposes only. And you really shouldn't listen to me or I say anybody else for that matter on YouTube or any other platform because our lives are different than your lives. And you need to figure out what's best for you and potentially even reach out to a financial planner for help in that stuff if you have some confusion with direction. Um, I know I talked about in another video, and maybe I do one specifically on it. Uh, I think just putting money in VOO and not even thinking about the rest for those who just don't even want to think about the markets but want to be invested. I see that as such a great option to not even have to pay attention. Um, but that's just my thoughts on it. Again, not financial advice. Oh, I also want to give a shout out to my buddy Koo. One of the things that I love about doing this stuff, and it'll be funny if he gets this far and makes a comment about it, is my best friend from high school, him and my buddy Seth, like the three of us were inseparable, all sorts of fun. Like we still talk about the things we did back then, which was, oh my God, 40 years ago. But he actually moved to France, and I don't get to see him very often. We still chat on, Facebook Messenger and we say hello. He actually watches my videos, which I think is super cool. It's really nice. It's nice that you're able to connect. One other reason as to why I do these videos because they really are for me. Um, anyway, if you haven't already, do me a favor and hit that subscribe button, smash the like button, make some comments in the comment section. I appreciate the couple of you who told me the other people you watch. I actually started checking out a couple of them to see if I like them as well. Have a great weekend, and I'll try to get some videos out this week as well, possibly even tomorrow.